The Fed has gone to levels we've never seen before. The biggest central bank balance sheet, the biggest growth in a balance sheet in such a short period of time as well. But it's not enough. More money printing is needed. Lower interest rates are needed. Overvaluations are supposed to become normal. What was once fictional is supposed to become reality. But in the end, everything must revert to the mean. There are no exceptions. You came here for the truth, so let me unveil that for you. Today we are going to talk about my favorite topic and yours, the central banks. I want to talk about what's going on with the Federal Reserve specifically. I want to show you what's going on with the economy as well. The stock market, of course, taking a hit today. I'm sure you saw that already. And why? Because Powell said no to negative interest rates. We'll start with a bit of humor today. You can see out of CNBC, Powell says the Federal Reserve is not considering negative interest rates. I'm sure we're going to come back to this 2 months from now, and we're going to be laughing because they're going to go into the negative. If they don't go into the negative, of course, they still have their QE and they can ramp that up significantly. They can also impose all kinds of new measures, whether we're talking about buying stocks directly or perhaps expanding on their other programs that they've got going. They've used every letter of the alphabet twice over, perhaps they'll do it a third round. I know there are fans of the policy, but for now it's not something that we are considering. He looked at this in a way in which the ECB, the Bank of Japan, and others have ultimately not been on the same page with, and that is, do negative interest rates actually work? Do they promote growth? Do they pump up the asset prices? And if you see it with the Bank of Japan and with the ECB, it's clearly evident that it is not successful. So I could definitely agree with that part of it. However, what they're doing doesn't work either. Quote, deeper and longer recessions can leave behind lasting damage to the productive capacity of the economy. That's directly from Powell's own mouth. Avoidable household and business insolvencies can weigh on growth for years to come. He said the Fed would continue to use our tools to the fullest until the situation has passed us by. So that essentially just highlights what I spoke about a moment ago. It doesn't look like they're going to go into negative territory. They'll probably go more towards buying all types of assets, instead expanding the balance sheet, because if they bring this negative interest rate policy in, that's going to hurt them in different ways, because the world looks to the US as a way to put their money in, seeking returns. If they start to go into the negative, of course, the entire financial system will follow it, and we're going to have some big problems. Powell says more policy help may be needed to pull the US out of economic downturn. Of course, they're going to have to do this, and usually the Federal Reserve, specifically Jerome Powell, will mention that fiscal policy needs to be used. And what he's talking about here is the government needs to do more. The government needs to send more paychecks. The government needs to make the loans out to people, and the Federal Reserve is only capable of so much. They know exactly what's going on. They know that it can't fix any problems, and they've made that very clear. In fact, I'm going to show you a paper directly from the Fed in a moment that confirms it. This article here is talking about gold and how we've seen it climbing during these uncertain times. The Fed has a number of other options, so it's possible we could see additional quantitative easing or continued policies that would allow for a positive backdrop for the gold market. We expect interest rates globally to remain low and negative in some countries, and that continues to provide a favorable backdrop for gold. When you look at gold, essentially you are watching the failure of the central banking system. As the price moves higher and higher, it becomes clearly evident what's happening with the value of the currency. It doesn't mean that there's anything with that gold. It's exactly the same gold it was 10 years ago, 1,000 years ago. It doesn't matter. It's always the same lump of gold. But what has happened here is that the currency has devalued. So when you make a bet on gold, you're making a bet against the central banks. You have to understand there's a difference between what the central banks say and their actions and the results of those actions. It's very clear that as the years go on, the currency is worth less and less and less, because every time you go to the grocery store, things cost more, your electricity goes up, and everything becomes more expensive. And if people only understood how the central banking system works, I think they would be very upset about it all, and they would demand a new system. This paper is directly from the Federal Reserve's website, specifically the St. Louis Fed, evaluating unconventional monetary policies. Why aren't they more effective? Here they're talking about Federal Reserve's large-scale asset purchases, LSAP. Our model predicts that unless private asset purchases are highly persistent and extremely large, on the order of more than 50% of annual GDP, money injections through LSAP cannot effectively boost aggregate output and employment even if inflation is fully anchored and the real interest rate significantly reduced. Now they're going in that direction, if you can see, compared to the GDP. They are expanding this at such a rapid rate. We're moving towards $7 trillion on the balance sheet, and it won't take long before they're at that 50% of annual GDP level. I personally don't think that going this route is going to solve the problem regardless, but at least we have an acknowledgement coming directly from the Fed saying that what they're doing doesn't work as intended. In this article out of Bloomberg, they list out all of the different programs that the Federal Reserve is currently doing, and it's unbelievable if you haven't seen this list before. It's every letter of the alphabet, as I've said, and unfortunately it looks like they are expanding them rather than contracting them. But he makes a very good point at the end here that's important to acknowledge. To put it bluntly, the Fed isn't allowed to do any of this. The central bank is only allowed to purchase or lend securities that have a government guarantee. That's why they went this different route. They didn't want to expand what they have been doing, requiring Congress. No, that would be too difficult. They needed to act through the Emergencies Act and make this happen fast. And so they did that very successfully because the market's loving it. The investors are loving it. Everybody from top to bottom, 99.9% are favorable in their activities, even though they're devaluing your currency, your savings every single day. Legendary investor Stanley Druckenmiller says he doesn't like the way the market is set up. The risk-reward for equity is maybe as bad as I've seen it in my career. That's the level he's talking about. Some people would say, who cares what this guy says? He's this, he's that. If you'd stop focusing on the individual and look at the actual facts that they speak of, things really start to make sense. He also said, with the markets, the consensus seems to be, don't worry, the Fed has your back. There's one problem with that. Our analysis says it's not true. And I completely 100% agree with that statement. David Tepper says this is the second most overvalued stock market he's ever seen, behind only 99. Some people came out right away and were talking about how he's this, he's that. Again, focusing on the individual instead of looking at the facts. And you could see PE ratios are absurd. What they're doing is absurd. How fast the market recovered despite the economy still falling right now, that's not a good sign. If you look into it additionally, he's not necessarily shorting anything. He's just saying right now it's crazy. That's it. That's all he's saying. And that's the point that I often make. When you look at these overvaluations, maybe we see the RSI, for instance, you look at PE ratios, for instance, you just point them out. Doesn't mean you're shorting, but I see those comments all the time. It's ridiculous, but there's no shortage of ignorance these days. While Tepper acknowledged that the March 23rd low in the S&P 500 index may have marked the bottom, that doesn't mean you can't fall significantly from these levels. So I just wanted to make that clear and just explain what he said exactly, because people only look at headlines and they react to that and they don't even know the full story. Just look at what has happened recently. April's job losses eliminate expansion's entire gains. I don't know if you could see this on here, but what we're looking at is basically after the financial crisis, what has happened. Gains consistently over this period, at least they can manipulate them, making them look like this, and instantly, just like that, it falls off a cliff. So many statistics have been adding up like this, and I will continue to bring those to you. Northman Trader quoted Powell saying almost 40% of those in households making less than $40,000 a year lost a job in March. At least we saved the NASDAQ and its shareholders, that's right. You could look at what has happened and it's unbelievable to see it, but so many people, particularly when he's referencing here, 40% of the households making less than $40,000, they don't have a job anymore. Their lives are crushed. And yet we still talk about this V-shaped recovery. It is truly an insult and a slap in your face if you believe it. The outspoken billionaire is back on CNBC, quote, "There should be no doubt that we have completely divorced the economy from the stock and bond markets. All of this money is going in to prop up companies. What you are going to start or accelerate is a really bad deflationary super cycle." I can't confirm that, but at least when you look at what they're doing, it is dislocating the two, and that to me is very clear. Just take a look at the federal government spending. Yes, that has been growing every single year, and there are times in which it goes really high, and then others where it's not quite as bad and the trend is downward. But we see the trend line, and that is up. This chart goes from 2000 all the way to present, but right now it has looked so ridiculous, so unbelievable during the financial crisis, during the dot-com boom and bust. All of these times look like nothing in comparison to what we are seeing today. They're pulling out all the stops, and I'm not sure how this isn't going to end badly. Cumulative fiscal budget deficit in the billions of dollars, comparing all the years from 2011 up to 2020, and I'm sure you can guess which one 2020 is. It is looking horrible right now. The budget deficits are going to levels they cannot dig themselves out of. That's why they're trying to issue so many bonds, the new 20-year bond. They're hoping somebody's going to buy up the debt, but you and I both know the Federal Reserve will be the buyer of last resort. That's all for this video. If you found that informative, please give me that thumbs up. When you do, you're supporting me. I want to thank you for that. If you want to check me out on Instagram and on Twitter, you could find me at The Money GPS. If you are interested in learning how to sell online, you want to sell stuff, you want to create products, anything to do with e-commerce, I cover it here in this course for free, the AmazonGPS.com. My two books break down the economic system in a way that makes it easy to understand. I cover all aspects that you need to know. Take a look at the link in the description if you want the audiobook, themoneygps.com. Wait a second, don't go anywhere. This is a very important video. I hope you will watch it. Click on it. I'll see you there.